Your first question is going to be to react to what Larry and the President have said in the last couple of days. Is this tech and China related? Is it a long overdue correction? Will earnings come in and be the mother's milk of profits?
OK. I actually do agree with Larry Kudlow and with the President that it's a long overdue correction. I have been bearish for a long time on the US stock market, and like lots of other people, I've been wrong for most of that time. The very interesting question is why now? People are trotting out all the reasons that you would have wanted to get out of the stock market months ago for why it's happening now, and that is a much more difficult and interesting question. In terms of whether I necessarily agree totally with the President that the Fed has gone mad, or that the incentive structure of the entire US economy has been changed in the last 2 years, that I am not quite so confident about, but obviously he's got a job to do. I suspect, yes, it is fair to home in on the Fed, less on rates and more on liquidity, and specifically QT, quantitative tightening. If you look, that is beginning now at the margin, which is what matters. Quantitative tightening, i.e. the actual selling of bonds that they've accumulated back into the market, it is beginning to have an impact. You do begin to see tightening of true liquidity here in the States. When you combine that with what is now the other big economy of the world, China, also attempting to tighten, then you get all the ingredients for a classic liquidity squeeze, a classic correction.
You're echoing some of the thoughts of Felix Zulauf, who was on the show a little earlier, which is fascinating. But I want to bring up this FT article that you wrote back in September, Twilight of the FANGs.
Yes.
Tell us about this, and are we closer?
Well, we're very much closer. The last time I ran the numbers, if you go by the NYSE FANG Plus index, which is very popularly used these days as a proxy for the FANG stocks. For the uninitiated, that started out as being Facebook, Amazon, Netflix and Google. Now it generally includes a few broader stocks. If you take a look at how the NYSE FANG index has done relative to the S&P, excluding technology, they've actually lagged by more than 20% now since we got to the very top back in June. So the FANG leadership has been a thing of the past for a while. It's now turning into a very sharp decline. I think that has little or nothing to do with the actual fundamentals or the actual events going on within those FANGs. Again, plainly, Facebook, you had a great excuse to get out of them earlier this year. Netflix's CFO decided to leave not so long ago, which might have been a good excuse to leave there, and so on. But ultimately, the reason they're falling so much is that when you're taking profits, you take profits from those positions where there are profits to be taken, which means that they led us on the way up and they're leading us on the way down. But it does look to me as though generally, whenever anything becomes an acronym, it's probably the money has probably already been made. It looks like the FANGs are in the twilight.
Yeah, it's interesting to see the rotation, John. Good afternoon or good morning for you.
Yes.
It's Guy in London.
Yes.
You talked earlier on, John, about the fact that you are bearish on the equity market. The MLive team asked a question earlier on, which was how low can the S&P go? I sort of canvassed a number of TA guys, technical analysis guys, here in London, and they talked to me about the 2765 level. Not only because it's the 200-day moving average, but there's a whole load of other sort of support around that sort of level. Where do you see, what are you looking at in terms of getting an idea, a gist, of where this market could go if it were to fall further from here? Is 2765 a line in the sand?
A line in the sand. You need to draw. When you draw yourself a line, that always becomes an important point in its own right. If we're talking short term rather than long term, obviously in the long term we have what looks like an extremely overvalued stock market here in the US, and over the longer term, you can imagine valuations coming down a long way from where they are now. In the short term, I completely agree. I've heard a lot of people talking about the 200-day moving average as a number that people are very interested in. If you have been trading US stocks for the last year, then buying once it hits the 200-day moving average has been an extremely good strategy. That doesn't mean it will always in perpetuity be a good strategy, but it probably does mean that quite a lot of people are going to give it a try once more once we get down to that level. So I suspect the next very big test for the S&P will be when we do hit the 200-day moving average, and we'll see whether it does stage another bounce as it did after the big corrections earlier this year.